Welcome, everyone. I'm Amy Anderson, and I'm so pleased to have with me today Sandy Heit. Sandy is the founder and CEO of Modern CPAs, which is a boutique accounting firm that offers accounting, tax planning and preparation, business services, and financial planning. So welcome, Sandy. Thanks for joining us.
Hi, thanks. Happy to be here, Amy.
Great. Well, I asked Sandy to have a conversation with me today about some business fundamentals, foundations. As a plastic surgeon is starting a new practice, what are some of the key financial terms and principles that they need to be aware of in order to successfully and legally and compliantly run their business and understand financial statements and expenses, what's allowed, all those little nuances that none of us actually just know. We may have heard, we hear a lot from friends and colleagues, but we want to get the truth and the right way of managing your practice's books. So I am going to turn it over to Sandy, and we are going to jump in, I think, starting with financial statements.
Awesome. Hi, guys. I guess my first tip is don't get all your tax advice off of TikTok. I'm here, I was a CPA for many years, and then I also had a photography business for 8 years. And so small business owners, all business owners, it's a totally different hat than even just, providing tax services to folks. And I made all the mistakes in the book. And the reason why I started my business is to really help other business owners really do things right and not make the same mistakes I did. And so this is just kind of a presentation of kind of getting yourself set up correctly. And so you can, once you have a good foundation, then you can just worry about growing the business and like the things the why you started your business, rather than getting really overwhelmed with the financial stuff. I mean, we want to partner with our clients to really help them understand, but they're typically not experts in this area. So we provide that support to them. So I'll just kind of go through the slides and give some just general overview. And then as I can add things related to specific year practices, I will do so. Also, just to let you guys know, this is from a federal perspective. Depending on what states you are, some states conform, some states don't. So, but most of them, generally, there's some differences with depreciation. I'm in California, for example. We don't have bonus depreciation on some expense items, but most of the things actually conform. So it shouldn't be an issue. So just something to note. So I will go through here. And this is just, all this information is just for you guys as a legal disclaimer, and everybody's situation is completely different. So do not rely on this. It's just for discussion purposes. So just, that's why it's really important to have someone you can trust, because everybody's, situation is completely different. So just FYI. And so basically, when you're getting set up on your books, a lot of times people, they think about the profit and loss, how much income, expenses, am I making, and, how much profit and tax I'm going to pay. But, when you set up, what we typically see for surgeons are S corporations. And so, or LLCs sometimes. And I guess from a tax standpoint, there's, people kind of set up an entity for two reasons. One for liability protection, and then one for just, for tax planning, basically. And I think a lot of states actually you have to form a corporation and have a professional corporation for your business. Some states, there's a little more latitude. So, but most of the times you're operating, even it's an LLC, which is a legal entity, it doesn't actually exist for tax purposes. So we would choose to have it taxed. And typically we have an LLC taxed as an S-Corp. So just FYI, but when we do a tax return, so you have your profit and loss, but you have your balance sheet. And so many times it's really, for doctors, there's your cash, there's any fixed assets, equipment, things like that, autos. And then on the liability side, there's credit card payments, maybe there's some loans. And then the offset of that is just the equity. It's the amount of money that you put into the business, your profits, things like that. So you'll need to make sure that, when we do the return, we do both. And so that's why it's really important to have a really good accounting system. We use QuickBooks Online. We work with clients throughout the US, and it's integrated with everything. And it's simple as far as the technology. So desktop, all those kind of technologies are kind of a little bit old school. There's some instances where you should use it, but the way that we kind of do it, it's just been easier and it adapts really well to surgeons' practices, basically. And then basically just profit and loss, a standard profit and loss, so you just have regular gross sales and then operating expenses. Typically, we do see with doctor's office cost of goods sold if they're selling products. And so it depends on the clients and how they want to track their data and their specific set of facts. But a lot of times it's simpler if they are selling products and reporting sales tax is to basically kind of the cost related to those is what we kind of put in cost of goods sold. There's been, things like implants, supplies like that are higher ticket numbers. A lot of times, sometimes people want it in cost of goods sold. Some other times they want in operating expenses, but under supplies kind of have some subcategories like, like small equipment, tools, or even break out something that has a big, it's a big expense per one that you really want to track it. It's just having a separate sub account for that. So, and then basically after that, that's your net profit reported to the IRS. So.
And I think, sometimes when I'm talking with new doctors, financial statements can be a little intimidating. They've heard about P&Ls, profit and loss, income statement, balance sheet, but what are those really? And I would say, don't be intimidated by it. Work with your CPA and or consultant to understand what those statements mean. But I love this slide here, Sandy, because it's really just showing the simplicity, a profit and loss, also the same as a P&L, also the same thing as an income statement. Those are all the same words for the same report, different words for the same report. It's truly just what you brought in minus what you spent, and then you have your profit, right? Like that's if we boil it down into the most simple terms. And so as we go through this, Sandy's going to talk more about specific expenses, what's allowed, how do we categorize things, but don't get lost in the weeds. This is really, at the end of the day, it's a very simple math equation.
Yes. And just one thing to add for clients that have, if you have a med spa that's separate, sometimes we'll separate those by classes. So we'll have, if we can easily track direct expenses related to that, it might make sense to do it. I have clients that have both, but it just really depends, based on your practice and kind of what you want to follow. If there is revenue things, we might just set up a couple different revenue accounts, and all the expenses can be allocated. So that's why it's really important to work with your advisors, just to make sure that your you're getting the data that you want from that. So anyways, that's that. Documentation. So the one thing that is really important to treat your corporation like a corporation is actually treated like a business. And so really separating that, there's a lot of liability exposure there. So we want to make sure that our clients really treat it as a business, and there's not commingling. You're not paying a lot of personal expenses from the business. You're really, you have a separate bank account, separate credit cards, things like that, because that way that'll shield you if upon an audit at some point, if they kind of could look in and you just it's a mess and things are commingled with your personal, they'll say, hey, this doesn't exist. And so they can it's called piercing the corporate veil and come after your personal assets. So we always want to make sure that we, get everything set up appropriately and, you're tracking everything. And then also that just makes sure that you're really capturing all the expenses that you need through the business. And it makes it really easy. You link your bank accounts to QuickBooks Online and everything's hitting there. So, which is nice. Just a little note here on cash, though. I don't know if there's that much cash in, I guess, Amy, do you see that? Do they use that for some items?
Yes, I would say we still have quite a bit of cash that comes through the practices.
Is that people depositing, or is it also just on the expense side?
No, on the revenue side. So we'll have patients pay for surgery in cash. We often joke, it was a busy injectable day when we have a lot of cash, because some women don't want that hitting the credit card. So they'll count out their $100 bills for their Botox.
The one thing that the IRS is always looking for is underreported income. So just FYI. So if you have cash, just make sure you have a good system in place to make sure you're recording it. So, and if you want to have accurate financials. So if it's, so anyways, that's.
I'm glad you mentioned that, Sandy. I do think that's a question I get sometimes in practices, and I believe every transaction goes in their practice management system, their EHR. We want to record every transaction and then deposit that money. And then that will, like you said, it's hooked into QuickBooks. So those transactions that hit the bank will automatically flow in. I'm also really glad that you start off by emphasizing the separation of business and personal. I think it's an area that a lot of people understand, but we can muddy the line sometimes. And for many reasons, I think it's important, not just because the IRS says this is the way we're supposed to do it, but also keep in mind, if you run personal things through the business, you actually are deflating your profitability from a value standpoint. Your business looks less profitable. And that can come back to hurt you when you're trying to sell your practice, bring on a partner who wants to buy in, any kind of big practice transition setting. They're going to look closely at how profitable is the business, and those personal expenses running through it are actually taking away from it. So I often say, not only is it just the right thing to do to keep it separate, but also, it's going to benefit you at the time that you're trying to evaluate the practice. Sandy, I do have one quick question for you. It's very common that a new surgeon will incur expenses before they've actually formed their entity, right? They've hired an attorney, they may have started working with you or with me to start planning the business. How do you recommend are those expenses that can still be reported if it's in the same year that the business is open?
Yes, absolutely. So when we start working with clients, we just make sure we ask for anything that's pre-existing before they have the entity, or anything they paid for personally, because maybe they didn't have the bank account, all of that set up. And what we typically do, we work with to try to make sure that we get all the information, based on, how organized they are, that we're capturing all that. And then what we'll typically do is kind of do a journal entry to like put the, basically it's a contribution. It's a contribution to your business. If it's an S corporation, it's a shareholder contribution is offside. So we'll record those expenses, and the offside is just, you putting equity into the business. And I know that there's a lot of questions sometimes with like loans versus contributions. Loans, what happens is if you funded your business with loans, shareholder loans, and then you have losses maybe in your first year, you're going to be limited to those losses if you record them as loans. So really, we want to record them as a contribution. And if you end up loaning and if your intention, some people do set up shareholder loans and they really want to get paid back on that, then we would recommend we have a formal note with some terms and all of that to make sure that we're treating it appropriately. So just an FYI there. But we usually always do it as shareholder contributions on that side. So,
right.
All right. And I think one of the things is documentation. And this is where I think there is a lot of confusion. So people are like, well, hey, I just use this credit card for everything. I have these bank statements, I'm good. But the IRS, if you get audited, then in the unlikely chance, they're going to say, okay, you have all these things, but where's the receipt? This meals, entertainment, and it's a lot of times meals, travel, like bigger things like that. They're going to want to say like, okay, what is this expense? Why is it a business? Where's the receipt? And so we encourage, you're not going to have 100% of receipts for everything. Sometimes it's just best practice to we use QuickBooks Online has a receipt app. There's Dex, there's a lot of other things, but as long as you want to be able to have these as backup, if you use something like QuickBooks Receipts or Dex or some of these other Expensify, they basically match the receipt with the transaction. So in the case of an audit, you can have that support. And it says, okay, this was, for example, for my business, my husband also works in our business. So we have business meals. We're always talking about business, I guess, but at the end of the day, it's like being reasonable with it. But, if I go out or if we're, it's a business one, I will put like, okay, here's what it is. And here, whether it's a staff or a client or that, I take a picture of it. It matches up with that transaction in QuickBooks Online. I throw it away, the receipt, and then I'm good. And you don't have to worry about it. And it's just getting into that habit. It took us a while to kind of get there, but it's really helpful to kind of get into that. So and of course, for bigger things like auto purchases, things like that, like we need, somebody gets an auto, we're like, hey, send us your new loan docs, send us your purchase docs. We need that data. So receipts are important. And it's just as far as like, and there's a lot of ones too. If you get email, everyone gets email receipts now. So there's, with the apps, you can actually forward them to like QuickBooks Online, and it automatically, you get a unique email address and it links up. So it's making it really easy. There's great technology around this. And if you are, it's just one thing on cash on the expense side. An example was a couple of years ago, I used to go to a networking thing once a month, and I would have, tip the valet, like $5. So basically, I don't have a receipt for that, but it's just something I make a note of. And at the end of the year, we send out a business questionnaire for our business clients, and we're like, hey, what did you pay for personally? And it's like those kind of things, just kind of keeping track of that. So I feel like even parking things, everything now seems to require like a debit card or something else. So people don't typically use cash as much, but I just like to mention it. So you have any questions on this one, Amy?
I think we're good. Save those receipts and use technology to make it easy.
Yeah. I mean, also for your accountant too, because if you don't want to have a bunch of questions about, that's the one thing that having a great relationship with whoever you choose for your accounting, if, you guys are busy, and once your business gets up and running, you don't want to answer all these questions. So it's, it's important to, when you start working together, for them to have a good understanding of your business, your vendors. But then over time, as you're kind of doing stuff, if you have these attached receipts, then it eliminates all the questions and it saves up time on both sides. So, all right. And then checking and, checking and savings, that's what you typically have, just standard. Sometimes people don't have savings at the beginning, but, it's encouraged to set it up and, get in that habit. We work with clients when we start working, and they're profitable in that. It's like putting them out a certain percentage aside for taxes, maybe it's 15% of revenue, things like that to have cushion. And we work with clients depending on how, what their specific situation is, but we want to make sure you're kind of building up some cash reserves in the business. Maybe 3 months. 3 months is a good recommendation. If your business is unstable and really have, big peaks and valleys throughout the year, maybe you want 6 months or 12 months. So, like I said, here's the top audit item is unreported business income. And, in those cash transactions, that's the one sticking point. So, business credit cards, and this, if it's great if you can get a business credit card when you start the business, if you can qualify for one with points and things like that, based on like kind of what works for you. We have, some recommendations for different ones. There's like Chase Inc., depending on if you want cash back or travel or whatever that looks like. Sometimes, depending on your situation, you don't have that. You're not able to get that yet. So what we recommend is still like having one personal card that's completely used just for business, not commingled, if you need to use something for that in the short term. So until you can actually establish your credit and get a business card. So.
And I think that's important. If you do have one that you're using under a personal card in the beginning, set a reminder and transition that over to a business card as soon as you can. Sandy, you and I have a mutual client who has only pretty much used personal cards for years, for a couple decades, honestly, of having the practice. And the problem was when we went to the bank for a loan or a line of credit, the business itself didn't actually have a credit history because everything was tied personally to the doctor. So it really is important to get those cards in the business name as soon as you're able to.
And establishing low credit, so as you have expansion and things like that. So, yep. Cash, we talked about cash already. So this is basically the IRS definition. What is a business expense? It's basically anything that is ordinary and necessary for carry on a trade or business, which obviously, depending on what industry you're in, this could change significantly. So, ordinary and necessary. And I think our next slide is a little bit better. Does it increase the future profitability of your business? And then it could be deduction. So, and it just needs to be reasonable when you're kind of looking at these things. But there's also, which I like, is there's a lot of flexibility and creativity with this, right? So, nowadays we have, we're running our business. There's specific technical things that you guys need to keep up on, but there's also like, business seminars or business groups or networking groups or coaching or things like that aren't specific to, plastic surgeons, but they're just in general to or personal development that helps have an impact on your business. So those kind of things are also things that are important. And, and I think that's the one thing is people know their craft. They know how to be a doctor. They know how to be, I know how to be an accountant, but it's like being a business owner is completely different in the day-to-day, ups and downs that come with that. So I highly recommend coaching, by the way. So it's finding the right person to help you in different stages. And I think is really helpful. So anyways, but we'll go through, this is kind of like a general overview of, a lot of the accounts or, expenses that are available. And then I'll kind of break it down one by one. And there's always, I will get into travel, autos, and meals, because that's really the hot topic. Advertising and promotion. So this is obviously people have their website, there's SEO costs, there's marketing, things like that. All that stuff's deductible. If you have like networking, meals that you go to, networking groups, that's all part of that. If you have t-shirts made, like any kind of gear, that's kind of put under here. So anyway, it's a broad subject, and I don't know, is there a certain standard, Amy, that they talk about as far as a percentage of your gross revenue that should be based on to allocate to advertising? Some I've heard like 10%, for some other, we also do a lot of service-based businesses.
Yes. 10%, I think is a reasonable number to go with, but for a brand new practice, it's going to be quite a bit higher than that, because we don't even have the revenue. So, as of today, we're in 2023. I would tell a new practice to anticipate spending around $100,000 their first year on advertising and promotion. And that includes your website, SEO, digital ads, as well as the print things. I mean, I can easily up that number, but usually when I say 100,000, people kind of gasp. And so I try to work with that as a starting point. And so that might be much higher percentage in year one, depending on what your revenue is.
Got it. Okay. And then this is just something to note, which, there is this old IRS law that is basically that you are limited for customer gifts at $25 per person per year. And so I like to, this is one of those things, this is the IRS rule. However, I feel like real estate agents is a good example to kind of show you how this is. So as far as business expenses, are they ordinary and necessary? So realtors, for example, they always give out gifts more than $25 based on the cost of the home, things like that. So, if upon audit, that's something that could be questioned. I make it very clear. How I would argue, this is ordinary and necessary for their business. So this is an advertising and promotion expense. Mm-hmm. That might get kicked back. So I like to be clear as far as letting people know when they are giving things, it is the argument is it's really advertising, it's promoting your business, and we classify it as such. However, there is some exposure there. So I just want to let people know, and it's going to depend on everybody and their, it's a legitimate expense, as far as what that is. But I would say just don't go crazy on these things, because there's, you can push things, but if you're like pushing things too far, sometimes you just need to like scale back and be reasonable, So when you're looking at things, the dollar amount and things like that, does that make sense? Is that reasonable based on there? So just something to note. But we typically, those things will be advertising and promotion. So
good to know.
And then autos, this is always like a very hot topic. So if you are typically, if you're going to buy a new car, it's typically going to make sense to use actual expenses. But basically, you have the ability to choose whether you use standard mileage or actual. And this is going to depend on everybody's facts and circumstances. Like, how many miles are you driving through the year? What's the cost of the car? You know, like, do you lease? Do you buy? Like, there's such a specific fact pattern that kind of goes through it. So we always analyze that. And that's the number one question we get for each, you know, like, hey, I got to buy a car. What should I, do? But typically doctors, when they're running, like, they usually have successful practices. We're trying to find expenses. So typically they are, they're purchasing new cars, and then you're getting more bang for your buck. The one little nuance to this is once you elect to do actual expenses, that's what you're stuck with. So you can never switch back and forth. However, you could, like, your first year, maybe you didn't have that many miles, or maybe it's your first year and you didn't really have that much income in the business. So maybe you had some losses. And so you don't really want to, but next year you're really going to, like, take off, and you're probably going to need the deduction. So maybe we use a standard mileage rate your first year in the business. And then we can convert to actual once you're actually, running the business full time and looking at that. So it's very, like, fact specific, but we work with every client to make sure that we're kind of doing that. And just the standard mileage rate is really based on it's supposed to encompass, like, gas, insurance, like all the expenses kind of related to that. So it's all encompassing. And with gas prices going up, they kind of made some big rate change jumps in 22 to 23. So 23, it's 65.5 cents per mile. So, and then we'll go through a business mile. So with our clients at the end of the year, we always ask for total miles, and then what's your business miles, because we need that percentage to be able to calculate. And so this is
what would be considered business mileage? I mean, is this any day that I'm driving to work, driving home from work, driving to the hospital or OR from the office? Do I record all of that?
So basically, I will tell you with auto expense. So right here is the perfect thing. So it's whenever you're driving something for business, right? So a lot of times, I mean, you have most of our clients, I say all of our clients, actually, all our small business owners, if they didn't before this, we meet with them, they will have a home office after we go through with them. We want to get them set up, because what you want to do is establish an administrative home office. And that's where, a dedicated place in your house where you're working on the admin, that's where you're working on the business, because you're usually doing that, at different hours, things like that. But we want to have that area. And what that does is it also, by having this administrative, second office, even if you're going, wherever you're going, if you have your regular office, it typically commutes are not deductible. Mm-hmm. They're not business miles. But by having that administrative office, that means whenever you leave your house to go to the office, it so basically turns your commute into business. So you get more miles, more business percentage. Also, you get to, go through and deduct some from your home office expenses, where we'll talk about that a little bit later. So, but then, like, at any time you're going to meet clients, you go through networking things, anything like that, that's business miles. And then two, this is one of those things where I'm going to say best practice. So we tell clients what to do. We ask for the end of the year, what's your total miles, business miles? I'm not auditors. You don't need to send me support. Depends how detailed our clients are. I mean, in a perfect world, there's apps kind of like Mile IQ. I've tried it out for a year. And basically it's it's just an app that travels with you whenever you're driving, and it records all your miles. And then the ones that are like going to your commute, that's just saved as that's a business one. And then and the personal ones, you can get detailed like that. You can use your calendar, things like that. This is an area that I think I'm not going to lie, I think a lot of people estimate, but the better that you have, they will ask for it. So a good tip, if you don't have an electric car, because nowadays everyone has electric cars, but if you get your oil changed around the first of each year, then you have proof from a third party that's just of your total miles at least. And then you just got to worry about your business miles. So
it's a great idea.
So is that, and then also too, as far as the actual expenses, it's whether you, if you're purchasing it, there's going to be depreciation expenses that you'll be able to take, like the cost of the vehicle, or, if you have lease payments, it's the lease and the interest and things like that. So, and then too, typically we see this a lot. Sometimes people trying to push the envelope on the autos and having like, well, I have 3 Teslas in my business. But I'm like, they're going to look at that, and you can only literally have like one car that you drive primarily for business. It can be over 100% generally. You might have a second auto that you use, or, maybe a spouse has one or something, or maybe you do have one that you guys drive patients or something, that could be that. But there's, this is an area that the IRS looks at. And does this make sense? Like you buy a Tesla every year or whatever, because if you buy one this in the first year, and then you go to sell it the next year, like, oh, I'm going to get another deduction, you have to recapture all of that, depreciation expense. So there has been, I think it's the next slide, but basically if you buy a car over 6,000 pounds, you've been able to get a 100% deduction for that, which has been really great for our clients. It started a haircut in 23. It's 80%. Next year, it's going to go down to 60%. There's some stuff in the House that just got passed. They're trying to extend that to keep the 100% for the next couple of years. So fingers crossed that it'll get there. But it's a great expense. And so just thinking about that. So a lot of times we might have the business, like the primary auto on the books and then the second one, we might do mileage or something like that. Again, it depends on every person's facts and circumstances.
Okay.
One thing to note though, too, if you're not using the car more than 50%, we're not typically going to record it on the books. If you're reimbursing for like an employee or something like that, it'd be like a mileage reimbursement. But if it's a spouse's auto, things like that, we'll have you guys, that's something you pay for personally. And then that's something that we'll ask at the end of the year when we're recording, anything you paid for personally. So this is about the 6,000 pounds and talks about, I mentioned the reduction of how it's getting haircut at 20%. And then you can't, to get the deduction for over 6,000 pounds, it has to be purchased, not leased. If you have a car that you lease for a couple of years and then you decide to purchase it, and then whenever you decide to purchase it, that also can be used for depreciation, what you end up purchasing it for. And one thing too, it's some sticky situations or people that they've used it 100% for business. And then the next year we want to make sure that you're going to be using it over 50% over a couple of years, because there causes some not great tax implications if it drops below. So, and if you can, it's great to have the title of the business on the corporation name on the title. It takes a little bit longer to coordinate the purchase of a vehicle in the business. So just kind of let folks know. And sometimes they're not able to do this, which that's fine, but best practice is try to get the business name on it. So this is just more like frequently asked questions. This is something if, everyone's like, okay, can I do 100% now that I have my logo on my car? No, that has nothing to do with it. You can have your logo on your car and use it zero for business. It wouldn't be a business expense. So the cost to get it wrapped, sure, but actually that doesn't automatically make it 100%. So, and then also when you make the loan payments, when we set it up, when people purchase a car, we add the asset, we add whatever liability. And then when you make the payments on a monthly basis, we have to allocate that between principal and interest. So you're basically getting a deduction for the interest portion of it. So on that side. And this is buy versus lease. Again, that depends on you and your specific circumstances. Any questions on those, Amy?
No, like you said, it's a hot topic. I appreciate that you said that sometimes we are looking for that expense, and it is legit and legal to do this. We're not doing anything, in a gray area, but there are some parameters around that. I think probably the biggest mistake I see is really not tracking mileage in any meaningful way. That's hard to do, right? It's something we have to think about. It does take time. But it's one of those things that if in the event of an audit, you'd be very happy that you have that documentation ready. So
yeah. I think the commute's the easiest one because you could always backtrack that. Okay, I go to the office 5 days, times whatever that is. That's great. That's all those little extra things. So just having a system in place to be able to come up with something reasonable. Bank fees, finance charges, all of that's deductible is related to interest. And that could be something too. Let's say you had some personal credit card that you use at the beginning for some expenses and you paid some interest on that. We can work to figure out, okay, based on that and kind of come up with a reasonable amount if it's kind of buried in some other items. But anything related to, you lent getting money for the business to put in, that interest is deductible. Also, just something to note, sometimes they'll take equity from their home to start a business, things like that. That's something too that we see it all the time, but we want to make sure that we have that documented appropriately, that we're making sure that we capture that interest, because it more impacts on your individual side, you normally get interest expense, but it follows tracing rules. So we want to make sure if you're using it for business that we're reporting it in the correct place. So, and you actually get if you are using it, it is a legitimate business expense, but that's something you'd be paying for personally that we would kind of put a journal entry in at the end of the year and ask you about. So just something to note on that. Customer costs or project costs. I don't think that you would really have anything like this. I mean, there's supplies, things like that, but I don't think this is very common, Amy.
It's not. And I think this might be something we do outside of QuickBooks. We do kind of work out, we want to have an idea of what is our profitability on certain types of surgeries, especially if you have your own surgery suite in your office. We get a good idea of like what each case would cost. But yeah, I think at the specific level, this would be a level of sophistication usually for a mature practice.
Okay. Clothing uniforms, actually, that would actually be this doesn't always apply, but in doctor's office, a lot of times you have your scrubs and things like that. It's a deduction. So if it's a normal, if it's normal clothes that you'd wear on the day-to-day, that is not deductible. But for scrubs, things like that, then that's a deduction. And also if you get like in your office, if everybody wears t-shirts that have logos, things like that, we don't typically put it under clothing. That's usually under advertising promo, but that kind of falls under this. And then if you're like taking a trip, let's say, and and maybe you're speaking, you're going to a conference, a medical conference, things like that, and your dry cleaning is deductible. So just FYI.
Right.
That's clothing. Commissions and fees. I haven't seen this a lot in the practices I work with. Is it something that you see, Amy? As far as for referrals or anything like that?
Yeah. So actually, I mean, I'm glad it's on here more as a topic of avoiding it or being careful about it. I see you have the words fee splitting in quotes. In healthcare, that's definitely a danger zone. And that, we're even careful about, you talked earlier about gifting, but gifting to referring doctors, we've got to be careful we don't fall into any kind of any violation of anti-kickback laws. So, just be mindful of it. If you're thinking of doing any kind of cost share with somebody who's one, not a doctor, and two, not part of your practice, stop and call your attorney before pursuing, because most states are very specific about what's allowed and what's not allowed.
Okay, perfect. And it does say that on here. Some people are looking at it. Red flag.
Exactly.
Dues, publication, license, of course you have the license, anything's related to that. It's continued, continuing education is on the next page, but basically this could be business, it could be medical specific, things like that, and publications that you read about in the industry, all that good stuff. So it's deduction, continuing development. This is a pretty big one. I see a pretty big continuing education things, professional development. this is something if for maybe mature practices that are putting medical expenses for their employees, we don't see it that much, but we have. I'm a CPA, so we have licensing requirements. So I just kind of typically pay for their education, but it's usually it's well under $5,000 a year. Yeah, I just pay that directly. So
okay.
And then equipment purchases. So this is a big one because there's lasers and all these like fancy medical equipment. Basically, a lot of these things can be bonus depreciation. It's kind of similar to how it was with autos, that this is starting to haircut down. Bonus depreciation, down it's 80% this year. But now we're getting into, with that going away, there's Section 179. And if you have a profitable business and you're getting the depreciation or equipment deduction because you're writing something off, then you can take still 100% if it meets the test. So, and then they put this de minimis out about, 10, 15 years ago. But basically, if you're buying something, let's just say you're going to the Mac store and you spend $5,000. And so if we just looked at the receipt, you see 5,000, you're like, okay, I'm going to categorize that, or, capitalize it. But really, when you really look at that receipt, yeah, you have a laptop for 2,000 and you have some supplies and some other kind of stuff. So when you're looking at the details of that invoice, everything's under $2,500 should just go to the expense, shouldn't even hit your balance sheet at all. So even though in essence, sometimes like, let's say you buy a $5,000 piece of equipment, the net effect to your bottom line is the same, whether it goes through your P&L or balance sheet, but the way that it needs to be recorded for tax and accounting purposes is different. So it has to, instead of, if it's under 2,500, just goes through your profit and loss. If it is over, we have to record it as an asset and record a depreciation adjustment. So you still, at the end of the day, you can kind of get there as far as the deduction, but it needs to be reported correctly. So just something to note as you're buying stuff, because you're probably spending a lot of money at the beginning on all these different things.
And Sandy, does that include furniture and things that go into decorating and furnishing the office? Does that have that same $2,500 limit, and we would make it an asset? Okay.
Yeah, furniture, fixtures, equipment, things like that, like a desk, anything like that would fall in the same. And furniture and fixtures, 7-year property. Most equipment is 5-year, computers, things like that. So, and yeah, I'm trying to say useful lives, anything else on here. Yeah. So typically, like, again, even though bonus is like kind of hair cutting down for equipment, things like that, we can take Section 179 as a deduction. So that just kind of, and it has a little more qualifications on what things qualify. From all the experience I've had with doctors' practices, all the stuff typically would qualify. So I wouldn't see any issues on here. And then insurance, business liability. I know that's a big, you guys there's a lot of different insurance. Long-term disability is something that I think is an important expense that people don't really think about sometimes. But it's basically, if something happens to you and you're not able to work, you want to make sure that you're covered. So I would say to make sure that's something you might be, think about. That's a business expense. Other kinds of ones are, you got to make sure your auto insurance, life insurance premiums are not a business deduction. You want to pay that personally. And like I said, long-term disability, it kind of depends on what it is. We have, for our business, we actually have a long-term disability plan in place for all our employees. So and the cost is pretty low. When you kind of set it up when you first get started on your younger side, the premiums tend to be less. So, but it's just something to think about. Anything in this area, Amy, that's
yeah. What about, so we know that like medical malpractice insurance, that's deductible, that should be paid through the business. The business owner's policy, your general liability for the building, for your assets, those are okay to pay through the business. What about a disability overhead policy that's in place to help cover overhead in the event of a disability for the surgeon? Is that, since that,
I believe that would be, so I would with all of those, just looking at the policy and just see what makes, everyone, there's some nuances as, depending on, but that's benefit for the business. And some of these things, there, in some instances too, there could be things that it's not a deduction for the business, but it's also not income when you receive. So there's sometimes where there's could be some flexibility. So we always just get an understanding of what insurance policies are in place and make sure that we're tracking it right for tax purposes. And that brings on, this is another hot topic with, in health insurance. And typically, again, most of our clients are S corporations. And so either way, it's a deduction for the business owner. It should be paid for by the business, whether you have an individual plan, group plan, whatever that looks like. So, and then at the end of the year, it's just a reporting issue with the IRS, is that whatever the amount of the health insurance that has been paid, the business has paid, it needs to be reported on box 1 of your W-2. So, and you get another deduction, it's reported somewhere separate on your individual return. But when we get new clients, this is one of the things that a lot of other CPAs do not do. And so we do this on behalf of our clients. We make sure we have access to make sure this gets covered. We every December, we're like, Matt's trying to get it updated and making sure that gets done and it's correct and all that good stuff, because that's a pretty significant deduction. I have a family of 4 in California. It's a large deduction. So you don't want to mess with not being able to take it. So.
Now, Sandy, one thing that comes up often on the topic of health insurance, I have a lot of new practices that are just not in a position to initially offer group health insurance, sometimes just by virtue of having 1 or 2 employees, and they can't even get a policy written because they don't have enough people participating. So I'm often asked, how can I do this? Can I reimburse my employee for getting a personal plan, or can I just sign them up for a plan and pay it directly? I have others that want to just pay a stipend to the employee to then go out to the marketplace and get their own. Can you talk about how you would recommend handling that?
So when it comes to health insurance, I have an amazing representative that I always refer people to because it's fairly specialized, but typically there's really specific rules about reimbursements. And I mean, there are some health reimbursement plans. A lot of times, you're not supposed to pay them directly. There could be like reimbursements. There's just really specific rules that they can kind of cover based on, what works best. But I find that a lot of times what we end up doing is just basically increasing that person's salary to cover that amount of the monthly insurance expense, whether it's, if they wanted to give them $500 a month or $200 a month or whatever, then they just kind of include it that way. So, insurance, we know all the basics and stuff, but this is where I like to build a collaborative team. So, and I say, talk to this person. They're awesome and they'll get you all set up.
That's great. I think the one thing I want to be careful of is, from my understanding, just having the employee, if they pay the premium and bring in a receipt, it's not a reimbursable expense from my understanding, it has to be taxed.
It's not supposed, unless they have like a health reimbursement in place. So that's typically not the best way. And those are one of those things when clients ask, the way I always got to dive into my notes because there's just always so much stuff going on. But that's typically not the best way to handle that. But it is expensive. And especially, when that's the one thing I feel like when I started my business that I didn't realize. You don't realize how much benefit you got as for being an employee from when you have your own business, and you're like, oh wow, like I was doing really well, because you don't realize how expensive all those things are.
Right, exactly.
But yeah, and then what makes sense, and you might have, and this is also nuances too. We have a lot of people that they might be covered on their spouse's insurance or maybe a portion, but they're still paying a certain other amount, for that extra. That is also the business expense. So, we always make sure that we capture what's going on and that we're recording it correctly. If you do have a group plan, we need to come up with a plan to figure out, okay, how are you paying it? And making sure we are able to break out the the owner portion, to make sure we're reporting that correctly. So,
okay.
Meals and entertainment. Okay. For the last couple of years, we got 100% because of COVID, and they're really trying to reinvigorate the restaurants. Now in 2023, we're back to 50% deductible. And it says meals and entertainment, but back in 2018, entertainment deduction, they disallow them. So they're not really, there's a couple exceptions I'll go through on the next slide, but basically just meals generally are deductible. It needs to be a business expense, business, immediately preceding or following, associated with the business, have a clear business purpose, like who are you meeting with? Like every day your meals are not deductible, just, going to work in that. If you're traveling, over 50 miles, then those are business meals and those are deductible. But, and two, this is sometimes too, if you have spouses or other family members that work in your business and they are part of it, or they're part of your leadership team, it's, just be reasonable. I mean, yeah, you might be really talking about business, especially when you're starting it, like it's very consuming, but you don't want to be, be intentional with what you're doing. You don't want to see like five different meals a day with Starbucks and everything else. It's a little excessive. So, by the way, this is something here, this is just on California, that actually they allow 50% deductibility of entertainment. So, okay. Actually, Amy, so you're gonna have to scratch that. I will send, this is related to meals. So it's all meals. California has always been 50%. So the one version I'm going to give you for your clients to do, I thought I searched this for California and this one just snuck in.
Okay, no problem.
So scratch that, pause.
No problem. We'll edit that out.
So, yeah, edit that. And then this is just a guide. There are some meals expenses that are 100% deductible. Most cases it's 50%. An annual holiday office party, that's 100% deductible. If you do an open house, or if you're launching your opening of your business, that would be 100%. That's for like a marketing promotional event. If you're like giving a seminar or training, that it's 100% offer to the general public. And then, just rather, gatherings for your employees. So if you're doing like an annual party for your employees and you go somewhere like a sporting event or something like that, that would be deductible. It's just people sometimes really push this one too far. So they just want to make sure this is where it's just like using that reasonable, what's ordinary and necessary and reasonable.
Absolutely. And that is the entertainment portion of it as well. Like you said, the sporting event, the tickets.
So it's just being minimal, when you're looking at that, like that's the couple little things, but it's, in the grand scheme of things. But for bigger practices and bigger things, that could be a sizable amount, but it's still, is it reasonable within the business, the size of and I always just kind of look at stuff like what's your revenue, what's your expenses, how does it fit in everything? If it like really stands out, then, if you have, $2 million you're netting versus if you have 200,000, the amounts that are reasonable can be significantly different based on, depending on your number of employees and stuff like that. Office supplies expenses, those are 100% deductible. Professional fees, accounting fees are deductible. Attorney's fees, if they're related to business planning. Financial planning, there are some, I do offer financial planning, but due to regulatory requirements, I am actually not as under my CPA business. It's actually a separate affiliated business, but as a part of that, the financial planning fees, if it's related to business planning, is deductible. So in those situations for the planning that could be, maybe even up to 80% related to business, because business and owners, their financial planning is so integrated with their business. So it is related to that. So we kind of work with clients for that. And then just this is where the invoice, having an invoice. So if you're, some of these things could be significant expenses. And so if you're taking a larger amount, you just want to look at, do you have a reasonable, based on what's being done, is that reasonable? Or is this for your personal estate planning? So it's, making a reasonable, I mean, it's the expression that pigs get fat, hogs get slaughtered. You just don't want to cross the line on some of these things to raise red flags. So that's what I have to say sometimes to some clients more than others. And then also risk. Every client's like we have clients that are very conservative, and there's clients that it's not that they're not conservative, but they're just I will tell I'm not here to say yes or no. This is how you substantiate an expense. Mm-hmm. If you want to take this, these are the facts. This is, it's not just going out and spending more money to get a deduction, but maybe what are you paying personally that by maybe changing your facts a little bit, now it's a tax deduction. That's what we're really good at educating our clients to do, because once you guys get up and running, that's, it's highly profitable, and it's like, okay, can we look for deductions? So postage, delivery, rent, lease payments. Rent tends to be a pretty big expense item for our clients.
It's usually number 2 in most practices after employees' wages. So wages are usually number 1, and then rent is a close second.
It's expensive.
It is.
Also, depending on where you guys are. This is the home office that I mentioned earlier. And so there's a lot of miscommunication about home office, but really, does it increase the chance of an audit? Absolutely not. And especially when you have an S corporation, the way that to properly report it, we report as office space on your books. So basically, we're going to ask, what's the square footage of your office? What's the square footage of the rest of your home? And then we take a portion of any direct home expenses, and that could be if you're renting, your rent payments, but if you're mortgage, it's, your mortgage interest, property taxes, cleaning, maintenance, all of these specific home expenses. So we have a very detailed list, utilities that we give our clients at year end to have them complete. And these are kind of some of them they go through down. These are things paid for personally that we will do an adjusting journal entry typically to reimburse at the end of the year. There are some of our clients that they like to write themselves a check quarterly to reimburse them. I would say that's our more detailed clients, which is a smaller percentage of the clients that we work with. Most of them are kind of doing a journal entry at the end of the year. And at the end of the day, the home office expense, while it's great for tax planning, I don't know that it gives so much great insight about how profitable your business is. When we kind of look at things when we're breaking out, doing like a owner's compensation, there's certain things that the business pays for and things like that. Maybe they pay for your internet because you're using it more at home, or some things like that we kind of take into account. But typically it's not really important as far as the day-to-day, knowing the profitability of your business. So we usually just do a journal entry at the end of the year. Do you think that's true, Amy? Do you have anything to add for that you see? Or
yeah, no, I'm in agreement. I don't think I have anything more to add there.
Okay. And then to just give a little more description about, the requirements. It's a principal place that you use it for business. If it's a hallway that people walk back and forth, that's not really there. You really want just, separate space, and maybe it is a separate corner or separate, thing if you don't have a big house or that, but ideally it's just like a separate room in your house is great. So, and then that's what I mentioned about it's turning your commute mileage into business mileage, and this savings can be significant. So, and really it's about the percentage, like if your commute tends to be the biggest amount of people's drive time, so that could put your business percentage from like 40% to 80%. And when you're talking about buying like a Tesla or something and getting depreciation, and we're talking about a $40,000 deduction versus like an $80,000 deduction, it's significant. So, and then audit proofing, knock on wood, have never been audited for home office, but these are the kind of things that they would ask for, proofs. They would want pictures of like the setup, all things like that. So just useful information. Cell phones, business versus personal. So again, this is something that I will say is there's best practices in getting facts, and then our clients decide. So the IRS will they make the argument that unless you have a separate cell phone for business, that there's no way it's 100%. So basically the correct way is to actually pay your cell phone personally and then have the business reimburse you like 80%. I will say that a a lot of their clients. It's a minimal expense. The cost of a cell phone over the year, a cell phone plan, the 20% that's related to personal use, it's insignificant. So we just tell our clients the best practices. And, if some of them do pay this, just a cell phone directly from the business, it's not something that we, adjust or anything, but we just let them know that, hey, this is what they kind of look at. And, the exposure is minimal, but it's just FYI.
Good.
I don't know. I don't know at what point that this maybe needs to go away, because I know most people don't have home phone lines anymore, but it's there. And, if you have it, you just use it for business, same kind of percentages apply.
There's a few landlines still around.
Internet, that's the one kind of home office expense where a lot of times we'll, instead of taking the percentage of the square footage of the office versus the home, we'll take a higher percentage, 80 to 100, or, depending on what that is. Because typically a lot of times people are using the internet for business. They're depending on what's going on. So that one tends to be a little bit higher. And then if you have like an internet for the office, things like that, all those utilities, anything related to office should just be paid from the business account. So streaming media, things like that. If you have like videos or, Netflix account in your lobby for people to like watch, things like that, those are all deductible and can be paid through the business. Just it makes sense. And, you don't have, like if they kind of look at all of your stuff and there's like a whole bunch of, and there's multiple Netflix accounts and multiple all these other, and people have their home stuff in there, maybe not, but all the business stuff is deduction. And then at home, if there's something, it actually depends on the business. Maybe I don't know if there's a show on, or like something that people watch, or YouTube or something that people get their information, or maybe for marketing or something like that. Maybe you need to have these certain channels like for YouTube or stuff like that you pay a cost, like YouTube Premium, that could be paid for the business. So travel expenses, this is another very hot topic, but also I think one of the most fun topics. And this is where, when you're having a business owner, you can plan things appropriately. I feel like doctors sometimes are the reason that some of the laws have been changed to put parameters on these things. So there's a lot of cruises and things like that. But basically, when the IRS looks at it, they do differentiate between domestic and foreign travel. So I'll start with domestic. They're going to look at what's the number one business purpose of the trip. And if it's a business purpose, then, okay, you can get the deduction. We'll go through the things. If it's related to you might, I'm going to work from home, working somewhere else, or, things like that. What's the primary purpose? And that's primary personal. And then there wouldn't be any deductions for the trip. So when you are like looking at travel and like, okay, will this lead to this? And this could be like, a lot of times it's like for education or things like that. Like, there's this thing in Hawaii or whatever. Well, that's great. So, but then, that's a primary purpose, or you're going to network with somebody, or, like, what is that related to? And then is it deductible more than 50 days or business? Then it's 100%. So when you're kind of looking at that, it's a primary purpose. They look at a work day as 4 hours, a day. So, if you want to practice, like if you wanted to commingle and have like business, and I don't like to commingle, I should say, if you want to plan appropriately and strategically, then you could, let's say you're going to go travel somewhere maybe you're going to do a conference or something, but then maybe you're going to meet with network with some other surgeons or something like that. So you could maybe the seminars on a Thursday, Friday, and then you have some other meetings on Monday. As long as you have work days on Friday and Monday over 4 hours, then your lodging over the weekend is also deductible. So there's a lot of just planning that you can get involved to make sure that that those kind of things, to maximize what you can deduct. So, and then
Sandy, what about spouses going on those trips with you?
This comes on to.
Oh, I'm getting ahead of you.
Right here. It's coming up. Okay. But basically it's like, well, my business profit by going on this, like, I mean, and this is the kind of thing, like, I mean, people go to like Tony Robbins, business mastery, things like that. That's also kind of events. So I like to bring that up. Also, one thing is taking, and this will actually come up on another slide when we talk about spouses and things like that. But, I always find it's really good for people, when you're new starting the business or like as you have that, is actually to take time away from, like, just go by yourself or go with whatever and really just get away and be able to plan. I like to do this, like, or recommend clients do it at the end of December, January, to just get away from the day-to-day and just to set strategic goals for your business, and whether it's, and just be reasonable in what that is. Sometimes you could pay for those expenses in December to get a deduction. Maybe you're going to plan in the meeting in January, but really, like, take it seriously and, like, put pen to paper, make an agenda, like, really plan for this. And it's you get a deduction, but it really helps you to just get, when you're out of the day-to-day, helps you think about things differently and really, have better insight and, like, make it really intentional. And then you could do your annual minutes that you have to do for your corporation, things like that have that substantiation. So, so before the trip, this just kind of gives some tips, like emails are good if you're going to meet with people, if you have itineraries, obviously for a seminar or something. Spouse. This is going to depend if they're involved in your business. So if your spouse is not involved with your business, then no, it's not. The hotel would be, but it would just really be your ticket. And then, but if you're, my husband is on our board of directors. And so if we're traveling somewhere, we go somewhere, then to get a way to talk about that, then it's a business expense. Mm-hmm. It's a part of the business. If your kids are part of it, that's fine. But you really want to, what they're really looking at this is, are they really a part of your business? Are you really taking this seriously? Or are you just trying to, we get this a lot. Well, I brought my 5-year-old and I'm going to pay for all their stuff. And I'm like, well, this is where you need to just be reasonable and, like, what makes sense. But if, that's the thing, if you're going to, if there's a bunch of you guys going, your whole family, let's just say maybe the primary purpose is to go to this event, and you're going to bring all your family members and then have personal days afterwards. I would say pay for that, anything direct, like your hotel or anything from the business, but anything that's really more personal, I'd say pay for that separately. And then we'll go through those and work with you what's a reasonable amount to take on the business side and make a type of allocation. But that's where it's important to get and this is the foundations. As we work with clients, there's different phases of planning and things like that, and getting involved, with this, people are like, oh, should they be on the, this is a good thing to get your family involved in the business and your kids when they're older, and think, great about shifting income and having them kind of do stuff and all that good stuff. So that's kind of like next level, but just things to think about going forward. And this just talks about, like, your annual convention, like, kind of getting away. And then just deduction, or quick tips, is kind of setting things and appointments before you leave. Kind of, that's really good substantiation. Having messages when you get back. Prior to starting my business, I worked for a family office, and so we had to do this kind of. He had a plane, so we actually had to have very strict requirements for all these things. So we made sure that we had all substantiation of, like, appointments, itinerary. He had follow-up messages when we got back, like, hey, thanks for meeting with you, to make sure to substantiate the deductions because they were significant. So just better records are, amen. It's less, more is good.
Yes.
And this is the weekends counting as business days. Again, as I mentioned, there's also something on here as far as international travel that, when you're traveling internationally for something, it could totally be a legitimate expense. And those are the ones where you could allocate, like, hey, 50% was business, 50% was, it's not all or nothing, like where it is with domestic travel. So, okay. And this is where it's lavish or extravagant. So that's where you got to cross.
Those are rather subjective terms, aren't they?
Yeah. And this is utility expenses. For home office, we take a percentage. Anything related to the whatever they pay for rent or their office or whatever, that's 100% expense. Wages and salaries. those are all deductible for the people they pay for, that they're working for them. There's a lot of liability as far as employees versus independent contractors. And I would say work with, Amy, do you assist in this area as well when they're kind of getting people set up?
Yes.
Yeah. Okay. Yeah. I feel like this is where we get a lot of questions, but when Amy's setting people up, that's probably a hot topic, and how they should pay people, because, it's expensive to pay employees. And you can, let's just say if you're going to pay somebody something 1099 versus an employee, it's about an additional 10% of the cost, but it gives you a lot of exposure if people are employees and you're trying to not pay them correctly. And depending on what state you're in, we're in California, they are really brutal with this, but it depends based on the state and state income tax rates, things like that. But
I would say, one of the easy tests is, are you controlling the work that's being done in a specific way? So for example, the person who sits at the front desk is unquestionably an employee, because they're required to use your software. They're scheduling appointments the way you've told them to schedule appointments. They're preparing your charts a certain way. You are directing and managing their work. They're not independently showing up to just get a job done. An independent contractor, a great example, is an anesthesiologist. If you have your own operating suite, it's an outside professional. You're not telling them how to do their job. You're hiring them to provide anesthesia services. They come in and do that, and you pay them. They're not an employee. So those are some examples, but definitely practices, we get some different nuances. One of the things that comes up, Sandy, I'm getting ahead. It's on the next slide as we talk about the owner's salary.
Reasonable wage.
Yes. Oh, well, but for the owner specifically. So I had a new practice a year ago that she initially was just an LLC. She had not filed for the S election, but she set herself up on payroll and paid herself as a W-2 employee. And so when I caught that, we had to do some backtracking and realizing, she was overpaying because the tax implication was higher to pay herself as a W-2. But can you just talk a little bit about when you're an LLC versus an S-Corp, salary versus distribution, how you can pay yourself?
Right. So basically, for LLCs, they're typically, it depends if you have partners. If you're like a single member LLC, that is disregarded for federal purposes, which means that's on your individual tax return, which we don't like. It's just, that is the number one audited schedule, is a Schedule C. So we see typically for single owners that they're S corporations, but basically in LLC, what happens is, for tax purposes, it's very similar to if you didn't have an entity at all. So let's just say, I'm just going to say 100,000 for like ease of use, or let's just talk about what's a typical like range. Maybe we do like 500,000. I'll say 500,000 in this instance. So basically what happens is, if you have an LLC or no entity at all, you're basically going to pay income tax on that 500,000. You're also going to pay self-employment, payroll taxes. The threshold keeps increasing. It's close to 170,000. So based on the amount up to 170, you're going to pay an additional 15.3% on your income for payroll taxes. But they call it self-employment tax. So that's the same kind of difference. And then the amount over that 170, you're going to pay an additional 2.8%. So with people that have high wages, it makes sense a lot of the time to make an S election. So what happens is, when you have an S election, the IRS says, okay, you have to put yourself now on salary and pay yourself a reasonable wage. And so we work with clients and figuring out what that is, right? So we look at what's the total income that you get from the business. So let's just say 500,000. Typically, we want to make sure that we cover that that payroll tax base. So we'll usually have, at least 170. And then depending on, how profitable all these other things, it could be a little bit more. But typically I see the wages probably in around 175 to like 250. And then the rest of it is just, so basically what it is, it takes that initial 500 that if you had an LLC that just kind of flowed through to you. And when you have an LLC, it's just basically you're paying yourself through distributions to the business. You're just making, taking, there is no salary, anything like that. You're just transferring or writing yourself checks. So when you have an S corporation, you're going to put yourself on salary, and typically then we'll kind of max out your withholding for for Fed and state purposes. And then that's one piece of it. So let's just say you paid yourself $200,000 so on salary. So of that $500,000, $200,000 would be reported through payroll, and you would get a net check, and then whatever would be deposited in your individual would be based on whatever that net amount was. And then you're also going to pay yourself distributions on that additional $300,000. So you can, depending on, you could take out a certain amount every so often. I mean, just depending on how your, specific facts and circumstances are, you can come out, like if you got to figure out what you need on a personal side for living expenses on a monthly basis and making sure you're kind of taking a ratio of those. But most of our clients, there's a combination of wages and then distributions. And so just in that, that scenario, it's, you're still covering, you're still paying that maximum self-employment tax up to the 200, but based on, the 300,000, you're saving about $8,400 of tax by making the S election. So when you're first starting out and your income's lower, this can be, off 100,000, for example, by just paying yourself 50,000 wages, 50,000 distributions, it saves about 7,500 just on that small amount. So this is where we work with clients to make sure. The other thing is we work collaboratively with, if you have a retirement plan in place, because there's specific wage thresholds that you want to make to maximize, you might want to maximize your 401k contributions. So we work with clients to just figure out what that should be and work collaboratively with the financial advisor if they have one. So.
Great. Well, I appreciate you sharing those examples because it demonstrates it can make a significant difference from the tax standpoint. And so, I mean, my biggest takeaway for surgeons is talk to your accountant before you set your salary and pay yourself, and let's have a plan for how and when and what that looks like in order to, maximize the tax benefit side.
Yeah. And this is what we work with new clients. We're like, what's your salary? What have you paid yourself? And then we project, and depending on where they are on the income levels, we try to pay as much through withholding as we can, because the great thing about withholding is that there's no, if the amount of taxes that you pay can be paid all through withholding, it's paid as if it's ratably through the year. So in essence, I wouldn't recommend this, but just to illustrate a point, you could literally just give yourself one paycheck at the end of the year. Maybe through the whole year, you're taking distributions. You've taken out 500,000 out of the business. But then at the year end, we got to do a payroll. So we're going to reclass 200,000 of that as wages reported on your W-2 and pay, let's say, your taxes of 100,000 you had for estimates that you did not make throughout the year. That is when you pay through withholding, it's paid as a ratably through the year. So there's no estimated underpayment penalty. So that's just something to think about. Most of our clients, they'll pay themselves just regularly on wages. Some of them do once a month, and then some of them just do the regular cycle that they pay. If you have employees, you have to pay them at least semi-monthly. So
yeah. Okay.
Yeah. So that's reasonable wages. And then reimbursement. This is where we kind of chat about, if you spend money on the business personally, you want the corporation to pay you back. Well, we don't, some people like to write themselves a check. A lot of time we do this doing a journal entry, basically. And then trying not to have the corporation pay any of your personal expenses directly. If we recommend just taking a distribution, if you're going to pay something, and then from your personal account, making that payment. And that includes income tax payments at the personal level. Most of, S-Corps, they're flow through entities. So there's no federal tax. There's depending on the state, there might be a state tax, maybe not. So just getting the habits. And then the one thing is, I think, just what they for S corporations, you have to adopt what it's called an accountable plan. It sounds very fancy, but all it is really is a one-page document that you include in your corporate minutes that basically says that your corporation can reimburse you as a shareholder employee, get a deduction for it, and then you don't have to, and it's not taxable income to you. So you just, and that's how all these reimbursements work. It's called an accountable plan. So it's kind of like, the things that you're paying for personally and getting reimbursed for. So with partnerships, it's a little bit different because there's actually things when you have a partnership return, you might get like and I guess too, when it flows through to you, just something to clarify, if you have a partnership, this is not a disregard entity, a partnership with somebody else or an S corporation, you're going to get what's called a Schedule K-1. And that's what you will. So basically as an S Corp, you would get a W-2 that would report whatever wages that go in your wages. And then the rest of the profit of the business, after your wage deduction, things like that, will get reported on a Schedule K-1. We also put that goes on Schedule E on your individual tax return. So with partnerships, you're able to put unreimbursed partner expenses as a separate expense under your Schedule E on your individual return. And this is why if you're starting with a partner, it's almost better if you can to do some kind of partnership, because you guys might have, you might want to have one partner that wants to, he's like a Toyota Prius guy, and we have a Tesla guy over here, and then, or someone's working harder, or, like there's S corporations, everything has to be pro rata as far as distributions, things like that. So for more flexibility, typically for partners, it's going to make sense for, to have the business be run in a partnership. And then you guys could each have your own S corporations where you're able to, that K-1 can have that income come through, and then you can have your individual, your related expenses. And that helps fix that, the issue of, you guys having different expenses. But then also too, you have, I had a partnership that, I learned a lot from. It was a very short experience and I learned really quick. I would say talk about things ahead of time, but, you want to be very clear and set expectation, who's doing what, and make this agreement, get everything documented, always work with an attorney. Because what happens is, as you go along in the business, it's stressful running a business, especially if you're coming from never being a business owner. And, it's, there's all these things that come up, and someone, might be working really hard, someone might not be, and then is it fair? And so when you have a partnership or LLC, there's a lot of more flexibility you can come in with, like structuring those kind of things. So do you deal with many partnerships, Amy? And
I would say from a new practice standpoint, most are starting as independent solo providers, solo docs. But certainly then sometimes it does evolve into a partnership situation. So not an uncommon thing.
Okay. And that's what I see too. And like the plastic surgeons, they're all, it's kind of a unique kind of specialty. And a lot of times I see that they're just kind of by themselves.
I tend to tease them a little bit that they don't always play well together in the sandbox. It's something about that. The personality that's drawn to plastic surgery tends to be pretty fiercely independent. And that's okay. It's
very entrepreneurial. I like it because I can relate. I feel that's how I am. Like I'm an entrepreneur first, an accountant second, after, as you go through life and you develop more, awareness of yourself. So anyways, that's the reimbursed expenses. And these are the typical things: miles on a second auto, some kind of insurance, your business your business expenses for the use of your home, anything like cash related. And if you buy any groceries or anything for an open house or promotional event, a lot of times people just use the business card for that. So, but they could be there. And then just as this next step, it's just really, just record keeping, just make sure that just kind of get in the habit of kind of keeping things, because people change. I go through here as far as when we start working with folks, we download their bank statements, their credit card statements. We have a really good system for getting things organized, but it also is helpful on your side because there's things that we don't have, access to. And it's just a good habit to get into, and especially if you have an existing business and you're transferring accountants or doing banks. I see this all the time. Let's say you go through, maybe you're audited, or more likely it's just you're trying to gather documents because you're buying something and they need records, and you've switched banks and you didn't download things. And it's kind of a pain to go back and try to get all those things. So I would say just get in the habit of, I would say initially, if you don't have anybody, like just, downloading those things, or, on a personal, in the cloud, or, once you can hire an assistant or something, just have them as part of their kind of processes, do that. And then too, like for the cash expenses, people are like, I just am not going to spend the time to take pictures of my receipts. I'm like, great. Do you have a kid? Do you have an assistant? Whatever, just make a pile of them and then just have them. I mean, they're taking pictures. Like it's simple, and it's a great way to use your kids, especially when they're like, maybe 8 or 9, and getting them involved and kind of giving, so anyways, these are just things that we keep. I think calendar is really good. I run my life by my calendar. So if I had to go recreate my miles for something, I can tell everything by what I did on the calendar. So if you're not great at, detailed records, kind of just having your calendar there, or have an assistant run your calendar for you. I think that's the one thing is when you first start your business, you're wearing all the hats, but I would say get in the habit sooner than later to, try to get rid of the things that aren't growing the company and bringing the revenue, because you will, if too much time spent down here. This is when I was in photography, I spent way too much time doing everything when I should have started delegating and doing things, delegating sooner. So anyways, and that includes your bookkeeping, by the way. I think it's very important for people to have a good grasp on their financials and to be educated and know, meet with a professional that's going to help explain things to you. But is it a good use of your time? Just figure out your amount that you can make doing a surgery, and what else could you be doing with that time? So maybe you're spending an hour a week, an hour a month. If you don't have anything else going on and you're pretty savvy, hey, maybe it makes sense. But really, if there's some, and it doesn't have to be like, oh, well, I could go do surgery. Maybe it's like, I can actually spend time with my family. Like, you just got to figure out the value of your time, and is it worth it, and to what you can, hire out. So, and then this is just how long to keep records. There's this great slide here. Just for the most part, things have changed a lot because now things are so electronic. So it's not like you have boxes of things around. So it's not like people don't go through, oh, I'm going to go get rid of all of my cloud files or whatever. So, but typically the IRS never goes back more than 3 years unless they suspect fraud. So, you want to make sure you have at least the last 3 years. But things like income tax returns, if you buy, a major purchase, things like that, like your real estate, those are things you'll want to just keep forever. And then, this is, we're 2023, we have ChatGPT that just is like taking over the world. Like we have to, we are always trying to do things better. As we like to practice what we preach. We're always trying to make things more efficient and then try to pass that along to our clients. So, getting electronic files, here's different scanners. This is probably even newer updates to this. Cloud storage systems, depending on, we're a big Microsoft, we do Office 365. That email for the system is really great integrated. You have Teams, you have all these other things. I think that's what you use, right, Amy?
It is, yes.
And do you use SharePoint as far as the file storage?
Yes. Yep. And it just makes everything easy. Like you said, it's cloud hosted, very similar to Google. I think most of our clients are either on Microsoft or Google Workspace. So what I like to say is there's really no excuse to not save your files because it's super easy. And you already have the cloud storage by virtue of setting up your account and your email and all of that.
And Office 365, they're very secure. Like everything's very secure, which is really important. And then this is just helpful tips how to save something, file structure, file names for searching. So actually, that's kind of
Sandy, I want to pause. Can you show that slide again just for a moment? Can you go back one more? And the reason I want to just pause here is because I would say most practices struggle almost the most here, that the file systems are a mess. And it's not just their financial stuff, it's everything. There's, a shared drive of folders, and staff just puts things everywhere. So, first and foremost, whether you're in Microsoft or Google, setting permissions of who has access to your financial folders here. It should just be you, your manager, your bookkeeper, your senior level people who should be privy to this information. But I love the idea of the numbers in front of the name of the folder, so you keep them in order. So it's not just going to default to alphabetical. And just taking this would take 35 seconds to create those 8 folders, and then it becomes easy then to make sure you just save it in the right place going forward. And I know for some people that's like, oh, that's too much time. It is so worth it, because you do not want to be going back and searching email and every other place looking for documentation when you need it. Yeah,
true. That's like the work about work, spending all this time to try to find things to actually do. It's a big cause of inefficiency. So, and then here's like file names, so you can kind of search. We always start by like dates on things with our statements, things like that. So it's all in order. And then, we use QuickBooks Online. I know there's other systems out there. There's Xero, Desktop. I mean, it's kind of the industry standard. I don't love that Intuit kind of owns the market of stuff, but they do a really good job. And so that's kind of what we use, what we recommend. We actually if people aren't on QuickBooks Online, we don't really work with them, because that's our standard operating procedures. We know that works best. I don't want to try to learn other systems for,
Sure.
circumstances. Standardize your P&L. That's where Amy comes in. I mean, we work with her, depending on your industry, she has it all laid out. And I really love how she does the P&Ls, because there are things when you're thinking about selling your practice, things like that. We talk about these items that the business is paying for that wouldn't exist. It's paying that would, if you were an employee, that you wouldn't get the deduction for. So these things are running through the business. They're impacting your profitability. But when you go to sell, it's very easy for someone to be able to pull those out and see the real, all your personal doctor expenses, whether it's travel, autos, things like that. So I think that's really helpful. And then, like depending on how sophisticated your practice is really, and how much detailed you are, you can really you want to make sure your financials are giving the data that you want, so you can make good decisions. So, and this is just like in accounting, time versus outsource. And that's going to vary depending on everybody's facts and circumstances. But, I would say this is not for doctors or anything in particular. Unless you're an accountant, I mean, I don't do my own accounting for my business. That's not the best use of my time. My time is spent working with clients, doing high value, leading my team. So, maybe at the beginning, as you kind of might be learning stuff, it might make sense. But then that's the one thing to be able to, bring in revenue and, do all that good stuff, especially getting things started, getting clients that first year is probably, that's the one thing when you start a business is like your hat is like, where's money coming in? And, making
right.
sure you're planning strategically, doing things like that. So, and I think bookkeeping is really important, because when you have everything down, then it's going to make your life so much easier, because you're not going to have to be scrambling at your end. We're the way our firm works, and, it might work or might not, depending on what clients, what they need. But basically we do all or nothing at our firm. So we found out the best way for us to be able to provide the most value is if we work with less clients and provide more services. So our, what we noticed is we had a really hard time finding good bookkeepers. And so I brought that in. My background is being a tax strategist. So by bringing it all together, we're able to see what's going on in the business. We can identify, oh, wow, their income's really up. We need to, chat about taxes and all that. And it kind of eliminates the friction between having multiple people and we know how things should be booked from the accounting and the tax perspective. So not that makes sense for everybody, but just something to kind of think about as far as when you're putting together your team. So I think that's it. I think is there the right habits, just taking some time, trying to keep, I would say too, this is kind of maybe beyond the scope of this, but I think just setting aside time to work on your business each week. Maybe it's like 2 hours, but everyone's like, I can't do meetings. I have surgeries every day. But it's like, you need time to really focus on the business when you have a business. And like, whether it's, maybe a couple hours or depending on where that fits in, I think it's really important. The most successful business owners I've seen in any industry take that time to work on the business and make sure they're kind of doing stuff and taking the finances seriously to set themselves up. So
I think that's great advice, Sandy. And, another thing I encourage doctors is to ask questions. And, even some of this presentation, there might be words and vocabulary that they're like, what? I mean, I kind of know what depreciation is, but like, what does it really mean? And like, we talk about it because we live in this world and it's, we have an understanding, but don't be afraid to ask questions. There's no question that's too dumb. And anybody who's on your team of advisors should be an educator and should kind of have that heart of a teacher, that they are teaching you how to understand your business, how to run it. They should be your guide. They should not make you feel dumb or incompetent. And if they do, then find another advisor. I mean, there's plenty out there. So to ask questions. And even if sometimes I ask Sandy the same thing 2 or 3 times. I'm like, I know you told me this, but can you run it by me again? Because I just want to make sure I really understand. So important to understand it. And then how often do you suggest that a physician meet with their CPA?
It depends. Like we have different levels when we help with our clients, but I think at least semi-annually at a minimum. So with our clients, we meet with them, we do it during the tax return time, like around that, but we also do projections at year end. So we're always meeting with our clients in fourth quarter typically. And then, typically from April to the summer, that's from our basic, that's our lowest, the lowest amount of points that we touch on. We also, in ours, there's a certain amount of we're kind of on retainer, I guess you would say, as far as questions as they come out through the year. Some of them we do an annual tax strategy. When clients work for us, we kind of lay their foundation, but then things change, things like that. So depending on a lot of our clients, we meet with quarterly just to kind of track that, or we do some cash flow, some other CFO services. Some clients we meet with monthly, just depends on theirs. But I would say quarterly, semi-annual is what we typically see. And then just randomly as things come up, basically. I would say at the beginning, our first year with working with clients, it's a lot. We usually meet with them probably 5 or 6 times just to lay the foundation of getting, just really get an understanding of their business, getting their tax strategy in place, getting their accounting set up, making sure, what we're doing is correct and the reports kind of, so there is a lot of time up front. So but that time up front if you do all these things to get in place, it's going to save you a heck of a lot of time down the line. So
yeah, absolutely. I think that's great advice. Oh my goodness. I just had another question that totally left my brain. I'll have to edit that part out.
They just meet with their client at tax. They just meet with their CPA at tax time. And then they're like, the people really come to us, I think, when they're starting a business, I'll say, because when I first started my business, we dealt with all startups. My number one referral was a business attorney, and he just sent me everybody. And this is really kind of what I saw. I just spaced too, Amy.
We're tired.
But this is an important point. Oh my gosh. What was I I don't know. I just spaced out.
Startups, meeting frequently.
What were you chatting about? Because it's a really important thing. I don't really do this as much anymore because we're doing more established stuff. But
we're saying not just meeting only at tax time.
Oh yes. So this is what I want to say. Okay. You can start. You can redo this now in 2 seconds. So I would say a lot of times I worked with a lot of clients that have started businesses after being a longtime employee. And so they just really don't know how it works. So a lot of times their current CPA, it might not even be a CPA. Maybe they've been at H&R Block, and and now you're a business owner and your needs change. And you're going to need somebody that's going to be really a partner with you and help, answer your questions, things like that. And that person may or may not be a fit for your needs now as a business owner. Because a lot of, I would say to like 90% of CPAs are they just do your returns. They just kind of meet with you. And then maybe there's another 5%. Yeah, they'll meet with you and do more, but they're not that good. And then the bar's really low in the CPA world right now. It's just, so when we get clients, it's like, my client won't call me back. My client doesn't know how to do this. They're not being proactive. And so we have a brand new client that we're working with, and they're like, you're asking for too much stuff. And so we're trying to we're setting them up, but they're accountant before. I don't know how they ever did their taxes because they never gave them anything. Right. And so I don't just taking the data that you give me and putting it in a return. The best advisors will be like, okay, you should have had these expenses. What did you do for this? What did you do for this? And make sure they're capturing everything. And so sometimes when people don't have the great records, we try to come up with the best reasonable thing that we can have based on that client and then get them set up going forward, right? Because nobody's ever talked. I mean, we have clients that have been doing this for 10, 20 years and nobody's had these conversations. So that's something that we really add value in. It's just lacking in our industry. So, and I love working with entrepreneurs. That's all we work with. And I love helping. It's cool to see them when they start and then a year later and they're there and just really thriving, it's really cool. And it's just the freedom you get from being a business owner. It's, I don't know. I just love it. So anyways.
Great. And I think just a final note, if it wasn't obvious, talking through the presentation, there's so much of this that is tied to you personally, right? There's the business, there's the personal, I don't want to say there's overlap because we have separation. However, it really only makes sense to have your accountant do both. I would not recommend having one accountant for your business and then somebody else personally. If you're in a bigger group or partnership, there might be some times that happens, but it's so interwoven to the point that your accountant is looking out for you on both sides of it. They know that a change on the business side, how that's going to impact you personally. And so opening that all up, working with your accountant on all things business and personal is how you're going to get the most value out of that relationship.
And I will say that, I mean, for us, and just the way our business is, and if it's not really a planning, CPA firm, but we'd either do all or nothing. And that means, when I talk to clients, I'm like, well, what does your spouse do? Are they a W-2? Do they have a business? Because unless we're doing your whole picture, I won't, we have to do all of it. And that's meeting with your spouse. And if they have a business or whatever, because it just doesn't make sense, because I can't give you advice if I don't see your whole picture. And if I can't, and there's some little nuances but also for partners, I mean, we have a handful of those, but it's, again, we have to do all or nothing. In my experience, when I've made exceptions, I regretted those exceptions because of the issues. It's you want to look at the whole, the business to be able to provide them a value for how we work. That's not everybody's business, but that's how we work. And so we're just all or nothing. And that's, so just depending on everybody's facts and circumstances. Sometimes, they have it's completely separate and it makes sense. I'm like, you should work with that, accountant or whatever, but, or we'll refer them to somebody that just does tax or, maybe not accounting or whatever.
Okay. Well, thank you. I know this was a ton of information, but super helpful, valuable. Love having you as part of my advising team, Sandy, and really appreciate you being here with us today.
You're welcome. That was fun.